Welcome to another episode of the Empower Show. Today we're going to be talking about a permanent life insurance policy, particularly Index Universal Life or IUL for short. I'm excited because I will be telling you how the policy works, but also covering the pros and cons of the policy. Let's get into it. The way the policy works is really simple. You're going to have two buckets. One bucket is going to be your permanent coverage, meaning that it will cover you until 121 years and it will have the living benefit out of that bucket. So if you become ill, critical chronic terminal illness, as we mentioned in the living benefit video, you can use the death benefit while you're living, and the money that you take out will be deducted from that bucket in particularly. The cash value bucket will grow money in the index account. Index is really simple. It's linked to stock market like S&P 500. However, you have a cap and you have a floor, meaning when the market goes up 12-15%, you could be capped at 9% maximum. But when the market goes negative, it tanks and people are losing their mind and money, your money will be safe because it has a floor of 0%. So your growth will be between 0 to 9%, depending on what index you're attached to and what company you're using. I can tell you this, my own policy has been doing 8 to 9% on average in the past couple of years. However, when the market was negative, it was doing 1 or 2% on average. So it could be fluctuating between the 0 to 9%, but again, depending on what your cap. Okay, so there is three ways you can fund the policy. You could pay minimum, which is not recommended, but it's for when you have financial hardship, you're not able to pay the policy properly. You have the minimum option, which will pretty much cover the cost of the insurance. You could have a target or average payment, which will fund the policy where it builds a little bit of cash, but it mostly is building toward the cost of insurance. Or you could set it up where it's max funded, and now you're seeing true benefit of the tax-free cash value, because a lot of the portion of the money you put in will go toward the cash value bucket that you can borrow from later on. One of the benefits that it has that could also be one of the cons is flexibility. So it's really good to have flexibility, because if you're max funding this policy, however, you're not able to afford, you have a financial hardship, you cannot pay the maximum every month for a few months, you could go to target, you could go to minimum, and pretty much just cover the cost of insurance instead of focusing on building cash during the time of hardship. Flexibility can also be a downfall of the policy, because if you continue paying minimum or just being between minimum and target premium, you don't know how much cash value you're going to be building to cover the rising cost of insurance. So your policy could potentially lapse if you continue paying more toward the lower payments than max funding it or paying target. So to summarize, the pros is that you have a flexible premium, which can make the policy more affordable than your average whole life policy. If you have financial hardship, you could go back to target, or you could max fund the policy to build the most cash, which is the second pro. You're building cash tax free. You can borrow this money anytime you like without paying taxes on all the growth that you've had. Third pro is that you have zero as your hero, meaning when the market is tanking and everyone's money is going down the hill, you have the security of having your money saved, meaning you're guaranteed to never lose money within this type of account. One of the cons is the rising cost of life insurance. So if you're paying lower payments toward your policy could eventually lapse because your cost of insurance is going up as you're aging. The second con is the fact that you're capped. So if the market is doing 20-30% growth, you're capped at a certain amount, and that could be also one of the cons because you're not fully participating in the market. And the third con is surrendering values. So in the first few years of the policy, if you're not max funding the policy, you do not have access to the cash value right off the bat. Normally, the surrendering value goes away average about 10 to 15 years, depending on the company you're working with. And when the time is over, that's when you have full access to all the cash value that you built. But until then, you have access to portion of the cash value that you built. Obviously, there are different ways you can set up the policy, therefore you can have different results. A lot of people set it up for the benefit of the cash value and max funding it, and the fact that they get to grow money tax free. And you have to set it up properly to be able to get that result. And the other way is a lot of people set it up because it has flexible premium. You could be more affordable than a average whole life policy, and they could have it as a permanent life insurance, not so much for the cash value. The purpose of this video was to give you the overview of how index universal life policy can work for you. In the future videos, we'll be talking about how the loan of the policy works and how you could borrow money from this policy tax free. So if you got value out of it, make sure you share this video with a friend. If you're not subscribed yet, make sure you subscribe to the channel. And if you haven't seen any of our videos, I will attach the term policy and how living benefit works right here. You could check it out. But if you have, I'll see you on the next video. Until then, be well.